What's up, guys? Quick heads up before we get into the charts. This is the stat that matters more than anything else this week. The S&P just ripped 6% in 4 trading days, something that's only happened 3 other times in history. But going back through the last 10 midterm elections, the S&P has generated a median return of 0%. From the start of August through election day, it's flat every single cycle. So today I'm breaking down exactly what happens to stocks before every midterm election, why it shows up like clockwork, and what tends to happen once the uncertainty clears. By the end, you'll know exactly what to expect between now and election day and why I'm staying neutral here in my portfolio instead of picking a direction. Let's get into it. We have some macro updates to go through. A lot of craziness going on in the macroeconomic world. There's also a lot happening underneath even the indexes on the stock level. So we'll talk about that on the more micro front of things. Copper futures settled at a record high this week. That's something we've been paying attention to as a group. I mentioned the metals outlook back about a month ago. On a worldwide stage, calendar year 2026 global earnings estimates have never been higher. Okay, so these are estimates from analysts. We have the track record from 2016 all the way out to 2027. But yeah, global earnings per share estimates have never been higher. And is same as for the calendar year 2027. S&P is almost up 6% over the last 4 trading days. The S&P has only surged 5% or more in 4 days, 3 other times. Once 1999, another in 2000, and the most recently, November of 2020. This is a simple NASDAQ versus S&P ratio chart. The pullback in July is basically unwound all of the year-to-date NASDAQ over S&P performance. So yeah, it got back to par on a year-to-date basis as of the middle of last week. So yeah, we're at all-time highs, and the rolling 90-day correlation between the S&P 500 and the 10-year Treasury yield is right near its lowest. This is the most negative the 90-day correlation has been since 1999. So another thing that's hasn't happened since 1999 is this. And let's see, I just read something like that earlier. Yeah, that was when S&P was up 6% in 4 trading days. That also was another thing that only happened in 1999 and once in 2000 and 2020. So interesting. Okay. A forward 12-month earnings per share estimates for the S&P 500 semiconductor industry. So we just stripped out the semis. That whole industry, the forward 12-month earnings estimates, those are up 155% year over year. So that there's continuing to be growth in that arena. Overall, the whole S&P 500 index's forward 12-month estimated profit margin is at an all-time high. That's 16.8%. That is a 2.8 percentage points higher than a year ago, which is now stronger than the prior peak year-over-year change of 2.7 percentage points in July 2021. There's a 30 percentage point gap between the VIX and the VIX EQ right now, historically high. When, the question is, when will correlations go to 1 again? Haven't been there in quite some time. Intra-market correlations remain exceptionally low. Goldman Sachs recall it spiked about this time a year ago and 2 years ago. Interesting seasonality here. So what is this telling us when I say intra-market correlations remain exceptionally low? Well, it means that capital is being dispersed very, very wide right now instead of being concentrated in Mag 7 names. So that trend continues here. So this is dispersion, distinctions, and delusion. As markets rally, here's something to keep in the back of every trader's mind. The S&P realized volatility dispersion continues to rise towards the lofty peaks set during the dot-com bubble unwind, far exceeding the levels reaching in the 2008 financial crisis. We've been covering momentum in the last month, I would say, even before that. And momentum basically consisting of stocks that everyone's been kind of YOLOing in. So this year, that has been memory stocks like SanDisk in the US, Micron. You have NVIDIA in there, AI-related stocks as well. So momentum stocks posted its worst month since the 2000 top. It's ripped for 2 straight days, but the history of momentum peaks and crashes suggests the rally now and then drift with downside later. The hard part usually shows up months out. This is interesting. If you overlay silver over the semiconductor ETF, it's quite predictive. The silver future seems to predict the semiconductor stocks by 4 months as a leading indicator of sorts. So that's interesting. We'll have to keep our eye on this correlation to see if it keeps up, but it's something that Morgan Stanley research flagged. They're saying semis analog with silver stocks is in gear, implies a bounce before continued choppiness. Morgan Stanley's macro research, they put out this, and it's a very similar read, right? They're saying there's going to be a rip. This kind of trend continues of momentum. So a rally now, then drift with downside, they say, later. And then if we move on to silver, it's suggesting the same exact thing. So we'll have a slight bounce here, likely in the next couple of weeks. Then it'll end and drift down towards the end of the year. Closer we get to midterms, I think that won't help either. Especially this time around, because in America now, we have an actual threat of socialism, like communist socialism. I don't know what they call themselves anymore, but it's mental illness. And these people are winning. New York, we have Madani. And Michigan, we have whatever his fucking name is. No one can pronounce that shit, right? So yeah, we're politically, we're cooked this time around because I think Bedouins seems to be shifting left. So chips, let's talk about just chips. Chips have gone from 20% of the S&P 500 to 16. So this is what I'm talking about, where concentration is falling off a cliff. Chips have gone from 20% of the S&P to 16% during what is now what we're seeing the summer reset, Citadel says. Citadel is one of the largest market makers out there, / hedge fund as well. This is also from them. They're saying early summer excesses have largely reset, with retail selling of semi and memory stocks hitting 20 times the two-year average in late July. With leverage and concentration lower, the firm sees fundamentals retaking control and a lower volatility grind higher. So again, we see this confirmed 3 times now from major institutions. If we look at the S&P, if we zoom out and its valuation, the S&P 500's PE, so price equity ratio, versus the world index, ex-US, is now at its least since 2020, even though the market's at all-time highs at the same time simultaneously. This is very, very odd, right? This is also from Citadel. They're saying the technical reset we have been waiting for has largely occurred. So they're talking about the sell-off that we had last week and 2 weeks ago. July did not change the structural bull market. It reset it. And this could be the explanation. There was an unprecedented inflow into tech funds that occurred last week. This was the largest 5-week inflow to tech funds ever. But the market's euphoric and stratospheric rise has been predicated on ever-expanding CapEx, so capital expenditure, which it has been expanding. Investors face a real problem in the not-so-distant future. Hyperscalers' growth rate peaks in Q4 this year and trails off into 2027. All right, this is from Goldman. Around the past 10 midterm elections, U.S. mutual funds increased their cash holdings by an average of 0.4% of assets under management during the 3 months before the elections, and then reduced those cash positions by 0.6% during the 3 months post-election. Similarly, foreign investors on average sold 0.1% of their U.S. equity holdings during the 3 months before the election, and then added 0.5% during the subsequent 3 months. During midterm election years of the past few decades, the S&P 500 has generated an immediate return of 0% from the start of August through election day. Returns have typically improved as uncertainties subsided post-election, with the S&P returning a median of 6% in the subsequent 3 months. We've been tracking leveraged ETFs all the way from Korea. We've mentioned them once in a while in the US as well. In 2026, the trend has been that leveraged ETFs asset under management rose to all-time highs, as you can see in this chart. But now that has been cut in half. Leveraged ETF assets under management has been cut in half in the past 6 months. What was interesting is this is actually unchanged as a number year over year if you zoom out longer. So this is from Deutsche Bank. They have a couple of slides that I thought was interesting. The first one is, as a percentage of shares outstanding, though July 15th shorting in consumer discretionary stocks had jumped sharply this year, not a great timing while we are hitting all-time highs for whoever short consumer discretionaries right now. So this could be an area where some more rallying could occur just due to short squeeze mechanics. But yeah, consumer discretionary, I think, got overly beat up recently. The consumer still seems strong, and we do see, at least in the consumer sentiment, it is improving month over month. It might be hard for you guys to see on the slide because the image is kind of small, but the first slide shows in the orange, the semis, where money is going into. Okay. So semis is the highest right now. Software is in the light blue. That's third in place. Second in place is tech, excluding semiconductors and software. Okay. So that might be interesting too. But let's see here. How much capital? So there's 30 billion that went into tech, excluding semi software, under slightly 10 billion into just software stocks, and then over 90 billion in semiconductors. Okay. Now the next slide on the bottom, colors are the same. So semiconductors are in the orange, software is in the blue, and then tech, excluding software semis, are in the bottom. Okay. And then darker shade. So what is this chart showing? Well, it's showing, let's see, inflows in the tech more broadly, more broadly have been muted. Okay. Yeah. So that's interesting. So asset under management cumulative year to date as a percentage, it looks like semiconductors are 30% of asset under management's cumulative year to date. Wow. That's a lot. So 30% of investors basically are in semiconductors, or their portfolio percentage. 20% software. Wow. That's a large chunk. And then tech excluding software semi is a little lighter, just slightly below 5%. Okay. So yeah, it doesn't look like that's slowing down, at least the inflows into tech, especially semis. To those who keep saying that there are a lot of bears out there, I present you this. Tuesday, we saw the most call buying in the US market history. And euphoria doesn't even begin to contextualize the current environment. The call skew is to the extreme. This is the high call skew and is showing strong upside demand in call options, meaning traders are rushing to buy upside bets. However, when you couple it with the technicals, it can also point to a contrarian view. The blow-off vibes getting strong here. Gambling isn't confined to betting markets. Now we have option contracts that expire within the same day. So those I definitely don't recommend in the group, right? We only trade options that expire 90 to 120 days out, but these expire within the same day that you buy them, right? So they're called 0-day options. So 0-day options trading has surged to all-time highs in recent months. And this was a new product that came out last year, the 0-day options, but now it's just gone out of hand. Why do I call that gambling? The 0-day options. Well, first of all, you're not buying yourself enough time to be right. Second of all, the index in general lately has been an exception because there's a lot going on in the stock market. But on a normal day in a normal year, right, the index doesn't move that much. Like the S&P on average moves 0.3% on average a day, up and down or down and up. To try to capitalize that on options in a single day, to try to pick a direction. I mean, technically you could do long short options at 0 day, but the risk reward isn't going to be there because you don't have enough time to make more profit than what you would lose, right? And you couldn't make more than for how much you can make, let's say, you could lose 100%. So you could make 30%. You could risk 100% to make 30%. How about that? That's a better explanation. You could risk 100% to make maybe 30%. That's horrible math. We want that to be the other way around, right? So anyways, that's my rant about 0-day options. Don't do it, guys. Let's talk about Gamma. Bank of America saw that Gamma as of Thursday's close was a little change over the week. A modest 1.8 billion, but they note that most of that was tied to expiring options. We will have to see how much is rolled over Monday, but it appears Gamma will likely be thinner to start the week, meaning more potential volatility, which looks to increase on any market decline. Realized volatility rose this week and S&P hedger Gamma faced negative pressure as customers opened large intraday downside positions ahead of the FOMC policy action on Wednesday. Gamma ended July 30th positive at 1.8 billion. That's the 29th percentile last year. But the upside call positions, I think I skipped a line. But the weekly expiry on July 30th options, again, I don't recommend trading the weekly options either. Not enough time still. But those July 31st weekly options were the main contributors of July's customers holding short upside call positions, while outcomes depend on flow and spot levels, with hedgers now net short contracts near spot. Gamma could decline start the week as these positions have expired. Okay, so we have earnings still in play, right? We're still in the middle of that, and we have some key retail players actually reporting here pretty soon. Yesterday we had Costco, which I didn't look to see how the results were, but we still have some time on some other ones. We have Home Depot coming up, which personally, I'm not sure. Whim, I would say I'm bearish on that, but I would really have to look at the fundamentals first. And then we have Lowe's, we have Target, TJ Maxx, Walmart. The list goes on. Okay, I'm sorry. So I read that wrong. On top, I saw that was Costco. And I assumed that was earnings, right? But I actually read the event. It's not earnings. So August 5th, Costco reported monthly interim sales report. Okay, so it's a little different. They do have their actual earnings call on September 2nd. Okay, so there is time. But we also have Burlington. We have Dollar General, Gap. Okay, so these are some good lists. There's one that we've traded before. American Eagle Outfitters. That was a big 2025 trade for us. We have Urban Outfitters, which I would say I'm bearish on. That's just a joke, but hey, that might be an interesting one to look at. But yeah, now this is just retail, right? This is just brick and mortar. We still have hundreds of other companies reporting. So this is not just the only industry to look at. Speaking of earnings reports and looking at how markets are rewarding beats and punishing misses. According to FactSet, who looks from the 2 days before to 2 days after reports, in line with the high bar coming into earning beats, are being rewarded well under the typical amount, although improving from the prior week. As compared, though, to the 5-year average, it is down. It is down from 1.2% in Q1 and Q4 2025. Misses on earnings reports, those are now being punished less than average at negative 2.4, down from negative 4% the prior week versus the 5-year average of negative 3. Now, the last of which Bank of America said was the worst negative reaction since 2000. Okay. So this is interesting. I haven't seen this in quite a while, guys. I've been trading for a while around earnings reports. And yeah, it looks like markets are rewarding beats and punishing misses differently, where that's kind of reverse almost interim, where beats and earnings are not being rewarded as much as they were, and then misses are being punished less than they were on average historically. That's what's going on there. But, we do have a bull case. We have some bear case as well. But, I'm just going to be neutral. I'm not going to pick a direction as usual. I'm going to stick to that, especially now. But, we have the midterms coming up, and I expect a lot of volatility. So does the 3 other institutions that we tracked. So whatever happens, we are prepared. If you've made it this far, you're clearly the type who wants to know what's actually driving these moves, not just the headline. So here's the next one you should watch. Everyone throws around the word quant like it means something magic. Most people have no idea what these guys actually do or why the good ones think completely differently than the traders you see hyping algos on social media. I break down exactly what separates a real quant trader from someone just crunching numbers in the back office. And honestly, it just changes how you should think about your own edge.